Millions invest without realizing this, and two nearly identical ETFs, but one silently beats the other in retirement growth. It's not just about returns, it's about risk, balance, and long term payoff. Most retirement investors hear the same advice: just pick an index fund and forget about it. And while that's a solid start, there's a crucial decision most people gloss over: choosing which index to track. The two most common options, the S&P 500 and the total stock market, seem almost identical at first glance. But the reality is that where you put your money today could shape your financial outcome decades from now. This isn't just about a couple percentage points in performance. It's about exposure, diversification, volatility, and long-term tax strategies. When you're investing for something as critical as retirement, details matter. And this detail could end up being one of the most important financial decisions you make. Let's break it down so you know exactly what you're choosing and why it matters more than you think. What's inside each ETF? Breaking down the ingredients. To understand how each fund performs, you first need to know what they're made of. S&P 500 ETFs like VOO and SPY are built around the 500 largest publicly traded companies in the United States. These are the titans: Apple, Microsoft, Amazon, Tesla, Google, and so on. They represent roughly 80% of the US stock market's total value. You're investing in companies that are already dominating their industries, already cash flow positive, and generally seen as safer bets for long-term investing. On the other hand, total stock market ETFs like VTI and ITOT give you exposure to not just those 500 giants, but also around 3,500 additional companies. These include mid-cap and small-cap stocks that don't make it into the S&P 500. Think regional banks, niche tech firms, new players in healthcare, or small industrial suppliers. You're capturing the full spectrum of U.S. businesses, from the mega-cap giants down to the up-and-comers. So the choice comes down to this: do you want to bet big on companies that have already made it, or do you want a mix that includes the little guys too, some of whom may turn into tomorrow's giants? How performance compares over time. Let's talk numbers, because long-term retirement planning lives and dies by compound growth. Over the past 20 years, both S&P 500 and total stock market ETFs have delivered strong returns, typically in the 10 to 11% annualized range. But the key is how those returns are built. In years where tech booms and large caps dominate, the S&P 500 tends to outperform. That's because it's weighted heavily toward the biggest names in the market. When Apple, Amazon, and Microsoft surge, so does the index. However, during periods when smaller companies lead the market recovery or outgrow the behemoths, the total stock market pulls ahead. Because it holds a larger pool of stocks, it captures more of those under-the-radar wins that the S&P 500 misses. So while the difference in average returns might seem minor, often just a few tenths of a percent over decades, that adds up to serious money. A 0.3% difference compounded annually over 30 years could mean tens of thousands of dollars more for your retirement. But past performance alone isn't everything. You need to factor in volatility and how each fund behaves during market dips, corrections, and full-blown crashes. Volatility and risk. What's the trade-off? Here's something most investors overlook: broader exposure comes with more ups and downs. Total stock market ETFs include small cap stocks, which are historically more volatile. These companies have more growth potential but less stability. They're more likely to see big gains in bull markets and deeper drops in downturns. That added exposure might not matter much if you're in your 20s or 30s and have decades to recover. But if you're approaching retirement or planning to start withdrawing in the next 5 to 10 years, volatility becomes more important. Big swings in account value can disrupt your income plans and increase sequence of returns risk. S&P 500 ETFs, by contrast, are naturally more stable. The companies are larger, more established, and less prone to wild earnings surprises. If your risk tolerance is lower or you're closer to needing the money, this smoother ride could make a significant difference in how confident you feel. The trade-off? You may sacrifice a sliver of upside in exchange for less drama. Whether that's worth it depends entirely on your investment goals and personal tolerance for seeing red in your portfolio. One of the great things about both fund types is that they're extremely cost efficient. VTI and VOO both have expense ratios of around 0.03%, meaning you're paying just $3 a year for every $10,000 you invest. That's practically free, and a huge reason why both are excellent core holdings for retirement portfolios. In a tax advantaged account like a Roth IRA or 401k, the differences in tax treatment between the funds are negligible. Dividends and capital gains aren't taxed until withdrawal, or not at all in a Roth. That means you can focus purely on growth, not on tax strategy. However, if you're investing in a taxable brokerage account, total market ETFs may generate slightly more capital gains from rebalancing and dividend distributions due to their broader holdings. It's not a deal breaker, but it's something to watch if you're investing large sums outside of a retirement wrapper. Real world retirement scenarios. What happens over decades? Imagine this. Jason invests $500 a month into a Roth IRA for 35 years. He chooses VTY, a total market ETF, and earns an average annual return of 10.4%. Meanwhile, Ashley invests the same amount in VOO, an S&P 500 ETF, and averages 10.1% annually. At retirement, Jason ends up with around $1.4 million. Ashley's account hits just under $1.3 million. Both did well, both followed simple strategies. But Jason's slight edge in return, thanks to broader exposure, gave him a six-figure bonus at the finish line. That's the power of tiny decisions, compounding over time. Now flip the script. During a decade where small caps lag behind and big tech drives the market forward, Ashley might actually pull ahead. Her fund is more concentrated in the top-performing giants. So again, it's not just about returns. It's about how each ETF behaves through different market cycles and how comfortable you are riding those cycles to the end. Who should choose what and why? Let's simplify the decision. If you're in your accumulation phase, meaning you're still working, building wealth, and years away from withdrawals, total stock market ETFs are likely your best bet. They give you the fullest exposure to U.S. equity growth, and you'll benefit from the higher upside that comes with broader diversification. If you're within 5 to 10 years of retirement or already drawing down your investments, S&P 500 ETFs can offer a more stable and predictable growth pattern. The lower volatility can protect you from big portfolio swings that hurt more when you're regularly withdrawing. And if you don't want to choose, blend them. A 70-30 or 50-50 split gives you the benefits of both. You still get wide market exposure while tempering some of the small cap volatility. The truth is, either one is a solid long-term choice. But the best one is the one that fits your timeline, your risk profile, and your emotional comfort. If this kind of breakdown is helpful, make sure to hit subscribe. I break these strategies down weekly so you can make smarter, simpler financial decisions that compound into real freedom. Drop it in the comments and check out the next video where I show you how to build a full retirement portfolio using just 3 ETFs. Let's keep building smart. Let's keep building free.